I am Victoria LeBlanc, a financial advisor and practice manager at Raymond James. And today I'm going to discuss the CARES Act, which stands for Coronavirus Aid, Relief, and Economic Security Act, and specifically how it impacts you as an individual. This is a very large $2 trillion stimulus package from the federal government that has tons of different options for individuals to take advantage of to get you through these difficult times. So today I will specifically focus on the recovery rebates, unemployment insurance, retirement plans, and student loans. I'll also briefly discuss healthcare provisions and then provisions for homeowners and tenants. So for the recovery rebates, these are the checks that you have heard a lot about, $1,200 per individual and then $2,400 for married couples filing jointly. There's also an additional $500 for any qualifying child under the age of 17. So even if you have a dependent that is over the age of 17, they will not qualify for the $500. The IRS is going to use your 2018 or 2019 tax return to find out if you qualify or if you are phasing out of the qualification for this money. As you know, some of you have not filed your 2019 tax returns, and you do have an extended deadline until July 15th to get those completed. So we're going to talk about the phase out. The phase out is based off your adjusted gross income. Now, I am not an accountant, so I don't want to dig into this too much, but your adjusted gross income is your gross income minus above the line deductions. So these are business expenses, contributions to your IRA, things like that. It does not include a deduction for your itemized deductions and standard deductions. Again, I don't want to focus too much on that because I'm not an accountant, but if you have any other questions, I'll give my contact information. You can feel free to reach out to me and I can try and answer as many of those as possible. So for the phase outs, there's a $150,000 phase out for married filing jointly. There is a $112,500 phase out for head of household and a $75,000 phase out for single filers. So the phase out works as a $5 for every $100 over the income that was just listed. And this will be on a document that I also will provide so that you can look at these numbers more closely. But I'll repeat that. It's a $5 phase out for every $100 of additional income over those numbers. You're fully phased out when you have an adjusted gross income of $198,000 if you're married filing jointly, and then $146,500 head of household, and then $99,000 for a single filer. So I know that's a lot of numbers, but again, I'll provide this in a document so you can take a look at that. Another thing I wanted to touch on is high earners in 2018 and 2019. So for those of you who have a higher AGI, which is adjusted gross income, but are hurt in 2020 under what's going on with the coronavirus, you will still receive a credit. It just will not come to you until after your 2020 tax return is filed. So I just wanted to let you guys know that if you are phased out, you do have an opportunity to still get those funds later on down the road. And if you have specific questions, again, feel free to reach out to me and I will try and help on an individualized basis for some of those things. So per the Treasury Secretary, most people are supposed to receive these by direct deposit if you have a bank account on file by April 17th. So I want to stress this, the direct deposit that you have on file with the IRS is what they will be using to get funds to you by April 17th. I did read that the IRS is trying to get a website up so that you can change bank account information, but as far as I know, this is not up yet. So whatever you have on file is what they will utilize right now. Now, if you don't have direct deposit, they are going to be mailing out checks starting April 24th. They are beginning with the lowest income individuals first, and then it will proceed from there. One of the concerns that I've heard is if you've moved since your last tax filing, there is a form that you can fill out. It's the form 8822 that will update your address for the IRS if you are concerned about that. And then also another question I've received is Social Security recipients who are not filing a tax return. You do not need to file a tax return. They are going to utilize the information that they have on file for your Social Security. So you won't need to do any extra work with that. So that's just a broad brush overview on those checks that we've heard so much about. And I'll now move on to unemployment insurance. Before I get into this, I do want to disclose that unemployment insurance is run by each state. So although there are some federal guidelines, you will need to check with each state. Most of you guys are in Florida, but the federal guidelines are what they are pushing the states to do. It's not necessarily how it's going to be played out in each state. The one thing that they are doing is eliminating the waiting period, which for most states is around 1 week. So you can start receiving benefits sooner than you would under regular unemployment rules. They also are increasing your unemployment benefits by $600 a week for up to 4 months. That's a big deal. If you've ever utilized unemployment before, the average is about $400 a week. So that's a large increase to try and get cash in people's hands as quickly as possible. They are also extending compensation for 13 weeks in addition to the normal time frame that you would receive unemployment benefits for. I do want to note that under this new act, there is pandemic unemployment insurance. These are for people who don't normally qualify for unemployment insurance. So if you're self-employed, I would definitely encourage you to take a look at the unemployment insurance availability in your state, because you probably qualify even though you wouldn't have qualified under normal circumstances. So next I will talk about retirement plans. We will first talk about penalty-free distributions. So if you have a retirement account, you are used to normally under the rules having a penalty of 10% if you withdraw early under the age of 59 and a half. So most of you realize that when you put money in an IRA, you cannot take it out without penalty before the age of 59 and a half. There's also a mandatory 20% withholding if you have an employer plan and you take money out. This is actually waived, so you do not need to worry about withholding a mandatory 20% if you take money out of an employer-sponsored plan. Again, some of that, we're getting some feedback that plans are pushing back on that, but that is in the act. So if you have any questions for me, again, my contact information will be provided, and I'm happy to answer that for you. So as far as the distributions, you can now take up to $100,000 out of your IRA, employer-sponsored plan, or a combination of both. That is penalty-free, no 10% early withdrawal period. So it must be taken in 2020, ranging anywhere from January 1st to December 31st. You have that entire time frame to take this money out. It does not have to be immediate, But if you see down the road, maybe in November, that you're still struggling with cash flow and want to take money out, you can do that. One important thing I want to note on this is that it's eligible to be repaid over 3 years. So if you want to put the money back into your retirement account, you can do that, and it doesn't have to be all at once. It can be spread out over 3 years. So for example, if you took out $90,000, you can repay it over 3 years, $30,000 a year. This is important because any money that you take out is still going to be considered income received on your tax returns. So being able to put it back allows you to not report that income as received. So that's an important thing to note, because again, when you're trying to take and retain your cash flow, you're taking all these funds out, but on the backside of it, you have to remember that you're still going to be responsible for the taxes of any income received. So I'll move on now to loans from qualified plans. They have now raised the max loan amount to $100,000. This is an increase. The max loan used to be $50,000. So that's a big increase for people to take advantage of if they have funds in an employer-sponsored plan that they can take loans out on. You now can have a max loan of $100,000. You can also now use 100% of the vested balance. Previously, you could only borrow against 50% of the vested balance. So for example, say you have $90,000 in a plan. You can take a loan for $90,000. This is opposed to $45,000 that you would have been limited to before. Now for these loans, you have until September 23rd to be eligible for this rule. So if this is something you're doing, you do have a time frame, September 23rd, that you need to take these loans out for. Also, if you have a current loan on your plan, you can defer or delay payments for up to 1 year. So if you're currently making payments on a loan on your plan, you can defer those. Now, another note for retirement accounts is the required minimum distributions. So for those of you that are in a period right now where you are required to make those distributions from your IRA, this is waived for 2020. Also, if this is your first time taking an RMD, you can delay your 2019 and your 2020 RMD. This is an important thing that they threw in there because, as many of you may know, the 2020 RMD is based off of the year-end 2019 value. So if you have an investment account, you are aware of the fact that your year-end 2019 value is far higher than what your account value is today. So they're trying to make a concession for that and not require you to have to take out that 2020 RMD based off those 2019 values. Now, if you've already taken out your 2020 RMD, you can return it within 60 days and it's considered under the IRA 60-day rollover rule. This is a once per year rollover rule, so remember that. So within 60 days, you can return it and you don't have to take that 2020 RMD. Now, if it's beyond 60 days, there's discussions about this and we need a lot more clarification as these things progress. But under the rule, it states that you can utilize 3 years to put that money back in. So again, this is something that is still being discussed and clarified, but as far as we know right now, you will have 3 years if you don't make it within that 60-day rollover rule. And I know this is getting complicated, but again, I'm going to be available for questions if anybody has specific questions, regarding these different things. And then, of course, any unique questions to you, I can try and help as best as possible. So I'm now going to go into student loans. If you have a federal student loan, your payments are deferred. Now, this is not for private student loans. This is only for federal student loans. You are not required to make any payments until September 30th, 2020. So some of these have automatically been put into place, and you should have also automatically seen your federal student loan interest rates at 0%. That should have happened automatically. Both the deferment of required payments and the interest rate to 0% should have already happened automatically on your federal student loans. However, if you are making voluntary payments, those are not automatically suspended. So for those of you that are enrolled in any sort of auto payment plans, I would recommend that you guys go in and review that to make sure that you are not continuing to pay if you do not wish to be continuing to pay. Another thing I do want to note, for those of you that have a forgiveness program for your federal student loans, it would be prudent for you to defer your payments. If they are going to eventually be forgiven and you are within this time period where they're automatically being deferred, do not pay more than you need to if they're going to eventually be forgiven. And that's just an idea to throw out there. Also for the student loans, there's various different things you should be considering right now. If you don't have to make these payments and if you are in the position to do so, this could be a great time for you to move those payments that you've been making to your student loans to maybe some higher interest credit card payments that you're trying to pay down. So there's a lot of different things you can do there, but you are not required to stop paying. If you do want to continue to pay on your student loans, it's a 0% interest rate. You can start really digging into that principal and continue to make payments on that. There's nothing against that and nothing wrong with moving forward with that if you have the cash flow to do it. So that was my last large topic. I do want to discuss briefly the expansion of healthcare benefits. I do believe over-the-counter medication and menstrual products are now considered qualified medical expenses. So what that means, if you have a health savings account or a flexible spending account, you can now pay for these items and it will be considered a qualified medical expense in your health savings account or flexible spending account. They've now also added any telehealth or remote care services under that umbrella as well. So you can utilize your health savings account fundings for that as well. Now I will discuss homeowners and tenants. So for homeowners with a federally backed mortgage, there is a forbearance for those mortgages. It's initially for 180 days with an option to extend another 180 days. But remember, this is going in automatically for federally backed mortgages. There's a difference too between the payment deferral and forbearance. So at the end of forbearance, normally you're required to pay back that full amount. So say you were in forbearance for April, May, and June. At the end of that forbearance period, you would have to pay for April, May, and June. So this is a great time to talk to your mortgage lender and discuss these things with them because there's probably a few other options for you as far as actual payment deferral where they put it on at the end of your loan, or different options to make that a little bit easier to manage as opposed to having to pay a few months at the end of your forbearance period. Now for tenants, most states have implemented some sort of moratorium stating that you cannot evict tenants right now for non-payment. This also prohibits the charges of fees and penalties for late payments. Now, on a federal level, the federal government implemented that for all covered dwellings, which is rental properties that receive federal assistance. So that is already in play. The federal moratorium prohibits the evictions for non-payment on those dwellings. However, again, most states have implemented that across the board. So check with each individual state to see if you are under that same umbrella. So overall, I know this was a lot of information to take in, and we're receiving more and more guidance on a daily basis. So if you have any questions, especially if they're unique to your individual situation, feel free to reach out to me. I'm more than happy to help. Again, it's so much information. There's so much out there and it's constantly changing. So I'm here to help, and I look forward to speaking with you guys and helping you through this very difficult time.